Let's be honest, buying a home right now is just ridiculously expensive. Between the housing appreciation, the lack of inventory, and the current interest rates, your dollar just isn't gonna go as far. But wouldn't it be nice if you could get some money that you could use towards your down payment or your closing cost just because you're purchasing in Illinois? Well, spoiler alert, you can get up to $10,000 to use towards your next purchase by utilizing one of the various Illinois Housing Development Authority's programs. And if you stick with me till the end of the video, I'm gonna walk you through all of the general requirements, each individual program, and how you can get started by the end of this video. Now, we call these IHDA loans, and there are actually multiple different programs to choose from. So before we get into the specifics, we have to discuss the universal requirements and guidelines that apply to all of the programs. So let's start there. Requirement number 1, you have to have a minimum credit score of 640. Requirement number 2, you have to contribute the greater of $1,000 or 1% of the purchase price. So if you purchase a home for $300,000, you have to contribute a minimum of $3,000 to the transaction. Requirement number 3, you have to live in the house and it has to be your primary residence. So you can't utilize these programs on a second home or an investment property. Requirement number 4, the property has to be a single family home, condo, or townhome on less than 5 acres with a maximum of 2 units. So you can't utilize this program on a 3 or a 4 unit purchase. Requirement number 5, you have to complete an IHDA approved homebuyer education course prior to being able to lock your interest rate and secure your funds. Requirement number 6, you have to make less than the maximum income limit in the county in which you're planning to purchase. So as you can see, IHDA will break this down into targeted and non-targeted areas. And if you want to search for a property and see where it falls, you can utilize the link that's in the description to enter the address. Requirement number 7, you can't spend more than the maximum purchase price limit for the county in which the property is located. So just like the maximum income limits, you can see that IHDA will break this into targeted and non-targeted areas, and then further break this down whether it is a single unit or a 2 unit property. So we've talked about all of the universal requirements. Now it's time to talk about all the universal guidelines. And the guidelines go hand in hand with the requirements. So you should think of this like a big checklist to make sure that regardless of which IHDA program you might be interested in, you have to meet these requirements and these guidelines. Guideline number 1, the first mortgage has to be a 30-year fixed. So if you were shopping around for a mortgage and not utilizing an IHDA program, you might look at an adjustable rate mortgage, or perhaps you might look at a shorter mortgage term such as a 15-year or a 20-year. However, if you're going to utilize an IHDA program, there's no option. The first mortgage is always a 30-year fixed. Guideline number 2, your debt to income ratio cannot exceed 50%. So if you haven't yet been through the pre-approval process, that might just sound like lender jargon. But to simplify, part of the mortgage pre-approval process looks at all of your income and all of your debt, and we take a ratio, and we have to stay below a certain ratio. In this particular case, 50% debt to your income. However, I'd like to anecdotally add that just because the guidelines say you can go up to 50%, not all IHDA files will work at a 50% debt ratio. Guideline number 3, you do not have to be a first-time homebuyer to utilize these programs. That's a huge misconception. Remember, if you meet the requirements and you follow the guidelines and purchasing in Illinois, you can absolutely use one of these programs. Guideline number 4, these programs can be utilized with more than just a conventional mortgage. So you can utilize this down payment assistance with an FHA loan, a VA loan, or a USDA loan. Guideline number 5, minimum down payments still apply. Now this is where people tend to get confused, because if you remember back to earlier in the video, I said that you have to contribute the greater of $1,000 or 1% of the purchase price. Now this is true, but it's often not enough to cover the minimum down payment requirements. So if we look at an example, and let's assume that you were getting a conventional loan and were able to put 3% down as your minimum down payment. On a $300,000 purchase price, you have to put $9,000 down. So while you may only need to put a minimum of $3,000 into the transaction and utilize the down payment assistance to cover the remainder, you still have to meet the minimum down payment threshold. So let's just quickly map this out as a nice refresher on the different minimum down payment requirements. So if we have a conventional loan, the minimum down payment requirement would be 3%. If we have an FHA loan, it's going to be 3.5%. If we have a VA loan, it's going to be 0%. If we have a USDA loan, it's going to be 0%. We've now covered all of the most important requirements and guidelines, and it's time to look at each individual program. But before we do that, there's two universal things that you need to know that apply to all IHDA programs. The first is that IHDA sets their interest rates daily. Now, this is drastically different than if you were shopping around for a mortgage and comparing rates among different lenders. We all have the same rates, which means in this case, you're not rate shopping, you're shopping around for a lender that you are most comfortable working with, who you know can get you across the finish line. The other thing you need to know is that the funding on these programs does run out. So what happens is programs either get suspended or closed entirely if the funding dries up. This makes it even more important that you strike while the iron's hot if you know that you need to utilize down payment assistance to make your purchase. The good news is, once you have a home under contract and you've completed the home buyer education course, you can lock in your interest rate and secure your funds. Now it's time to get into the specifics of each program. And at the time of recording this video, only 3 of the 5 IHDA programs are currently available, but I'm still gonna walk you through all of them. The first program is the Access Forgivable. Now this one will give you 4% up to $6,000 of the purchase price to use towards your down payment or closing costs. Now all IHDA mortgages get recorded as a second mortgage, but each time frame and how they are either paid back or forgiven is going to be different. So this particular one is forgiven monthly over a period of 10 years. So let's say that you took the full $6,000. That would mean that each month for the remaining 10 years, $50 of that $6,000 would be forgiven. So let's say that you sold after 3 years. After 3 years, $1,800 of that $6,000 would have been forgiven, and $4,200 would need to be paid back at the time that the home is sold. Now remember, you might be saying, well, I don't want to have to pay that money back. Well, think about how much the home probably just appreciated over those 3 years. I'm willing to bet you made money. The second program is the Access Deferred. Now this one will give you 5% of the purchase price up to $7,500. The difference here is that you're deferring the repayment of that money until the mortgage is either sold, refinanced, or paid off in full. So let's assume that you took $7,500. And let's say that you stayed in this mortgage for 12 years. At that time, you sell your home, pay off this mortgage, that $7,500 will need to be paid back at that time. There is 0% interest, but you are deferring the payment until the loan is sold, paid off in full, or refinanced. The third program is the Access Repayable. Now this one will give you 10% of the purchase price up to $10,000, and it is repaid monthly over a period of 10 years at 0% interest. So let's assume that you received $10,000 in assistance. You would actually make a payment of $83.33 each month. Now let's assume that you sold the home after 3 years. During that time, you would have paid down just under $3,000 of that $10,000 that was given to you. So that means you would pay off the remaining $7,000 at the time of selling. The fourth program is the Illinois HFA 1. And this program is currently suspended, but should it come back into play, this will give you a flat $10,000 in down payment assistance that is deferred as a 30-year second mortgage. So what this means is that you don't pay anything back until that loan is either paid in full, should you stay in the loan for all 30 years, if you refinance, or if you sell that property. There's 0% interest, so you pay back that full $10,000 at the time any of those 3 things happen. The final program is the Opening Doors. And this program is currently closed, so we may actually never see this one come back, but this was certainly one of the most popular ones. This gave you $6,000 flat and was forgiven over a period of 5 years. So if you stayed in that loan for 5 years, none of that money had to be paid back. As you can see, these IHDA programs can be extremely beneficial in making homeownership a reality. And while they may look daunting at the surface, my hope is that this video has simplified what the requirements and guidelines are, as well as what program might be right for you. So if you're ready to get started, the process is super simple. Simply click the link in the description to complete the pre-screening questionnaire, and you can book your call upon submission. As always, thanks for being here. Please make sure to like, subscribe, and share the channel. We'll see you back here next time.